Okay, are we good to go?
Yeah, I'm ready.
Awesome. Well, welcome back to the deep dive. It is Wednesday, February 26, 2026. And I have to be completely honest with you right up front. I spent the entire morning just staring at my terminal and staring at the news headlines, and I feel like I'm living in two completely different realities today.
You are definitely not the only one. It's a very schizophrenic news cycle today, to put it mildly.
It really is. I mean, look at the board. Just look at the raw numbers. The Sensex is cruising over 82,000.
Yeah.
The Nifty has totally smashed past 25,000. If you just looked at the index, you would think we were in the middle of, the greatest economic party of the decade. Like champagne corks popping, everything is green, investors just high-fiving in the streets.
Right. The whole wealth effect is in full swing. Asset prices are basically suggesting absolute euphoria.
But then, and this is where it gets crazy, you actually read the news. You open the Business Standard or Mint or the Economic Times, or you dig into this incredibly dense AI manifesto we have in our sources today, and the vibe is completely different.
Oh, complete.
It's not a party at all. It's a pressure cooker. We have this credit crunch in the banking sector that nobody seems to be talking about enough. We have what looks like the actual beginning of a brutal new trade war with the U.S., and we have an existential crisis in the tech world about what a computer even is anymore.
It creates this massive dissonance. Finance Minister Nirmala Sitharaman actually had a quote today that I think perfectly defines this entire era we're in right now.
Oh, what'd she say?
She was talking about the difficulty of making policy right now, specifically regarding these global headwinds. And she said, and I quote, "Uncertainty level A in the morning, uncertainty level B in the afternoon."
Wow. Uncertainty level B.
Yeah.
I love that phrasing. It sounds like a hurricane category or something. Like we are upgrading this market to a category 5 uncertainty.
It really feels that way. And honestly, that is our mission for this deep dive. We need to bridge that gap for you. We need to parse through this incredibly dense news day to figure out how you actually operate a business or manage an investment portfolio when the morning forecast is totally different from the afternoon reality.
Exactly. And we have a ton to cover. We're going to talk about 126% tariffs.
Yeah, triple digits.
Triple digits, exactly. We're going to talk about India attempting to reclaim pharmaceutical independence in a way we literally haven't seen in 20 years. We're going to look at the credit deposit ratio flashing red. But I want to start with the trade war.
Let's do it.
Because for a really long time, the dominant narrative has been China plus one.
Right.
The idea was that the U.S. loves India, they hate China, so we are safe.
That has basically been the safety blanket for Indian investors for 5 years now. This idea that geopolitical alignment automatically equals economic immunity.
Well, someone just completely ripped that blanket off.
Yeah.
Because I opened the Business Standard today and my jaw just hit the floor. The U.S. Department of Commerce has imposed a preliminary countervailing duty on Indian solar imports. And the number is... Well, actually, you say it, because if I say it, it's going to sound like I'm making it up.
It is 125.87%.
126% tariff. I mean, that is not a tax. That is a blockade. That's a wall.
It is effectively a wall. And to be clear on what this actually is, this is a countervailing duty. The U.S. is alleging that these specific products, crystalline silicon photovoltaic cells, which are basically the heart of any solar panel, that they are being unfairly subsidized by the Indian government.
Subsidize how?
Well, the argument is that New Delhi is giving these companies just way too much help. Cheap land, cheap loans, the PLI schemes. And the U.S. is saying that allows them to sell below market rates in America, which hurts American manufacturers.
So the U.S. is basically saying, you are cheating, so we are going to tax you 126% just to make it fair.
Exactly. And it's not just India, to be fair. They slap different duties on Indonesia, Laos, and Cambodia, too. But the Indian duty is by far the steepest. And this is exactly where that China plus one narrative hits a massive brick wall.
Because the whole assumption was that friendshoring meant tariff-free. We thought that because we are strategic partners, Quad members, defense partners, that we would just get a pass.
Correct. And clearly we do not get a pass. You really have to look at the broader political context here. We have reports in our sources that President Donald Trump is signing a directive to raise global tariffs to 15%, quote-unquote, where appropriate.
Right.
His trade representative, Jamieson Greer, is trying to sort of thread a needle here. He talks about continuity for nations with trade deals, but the baseline instinct of this administration is pure protectionism. It is America first, not America's friends first.
So even the friends get the bill.
Even the friends get the bill. Now, the tariff on China is staying up there in the 35 to 50% range, but hitting India with 126% on solar. That sends a very specific message. It says that if you build a strategic industry using government subsidies, the U.S. will penalize you, regardless of whether you are a geopolitical ally or not.
Wow.
It's a massive warning shot across the bow of India's whole industrial policy.
That is such a crucial distinction for people to understand. It's almost like the U.S. is saying, look, we want you to succeed against China, but just not too much. Like, don't threaten our domestic manufacturing while you do it.
Precisely. It is economic nationalism first, alliances second.
Okay, so let's look at the actual companies involved here. The report specifically mentions Vikram Solar, Wary Energies, and Premier Energies. These are the big players. Now, if I'm holding their stock today, or if I'm the CEO of one of these companies, I am panicking, right?
Yeah.
126% duty basically means I can't sell a single solar panel in America.
You would think so. Logic definitely dictates panic in that scenario.
Yeah.
But the reaction from the companies has been fascinating. They are projecting extreme calm.
Really?
Yeah. Business Standard reached out to them, and the consensus response was that this will have a, quote, limited impact on their operations.
Okay, stop right there. How on earth can 126% tax have a limited impact? Are they just in deep denial? Is this just corporate PR spin to stop the stock from tanking?
I don't think it's pure denial. I think it's preparation. 3 distinct things are happening here. First, this investigation actually started back in August.
Oh, so they saw it coming.
Exactly. They knew this was coming. They likely front-loaded shipments or adjusted their contracts months ago. Second, the solar market is global. If the U.S. shuts the door, these companies just pivot. They pivot to Europe, to Africa, to the Middle East, where demand is also incredibly high.
But the U.S. is the premium market, right? They pay the best prices.
That's true, but that leads to the third and probably most important point, domestic demand. India has its own massive targets.
Right. We have Prahlad Joshi, the renewable energy minister. He's quoted in today's sources, saying they expect $350 billion in investments in the RE sector by 2030. The government has these huge targets for green energy.
Exactly. So if Wary or Vikram can't sell to Texas, they just sell to Tamil Nadu. They sell to Gujarat. The domestic appetite is voracious enough to absorb a really significant amount of that supply.
So the thesis for these companies kind of shifts from being a global export giant to being a pure domestic infrastructure play.
That is exactly the pivot. But for you, the listener, if you are holding these stocks or looking at entering the sector, you really have to understand that the margin profile changes when you make that pivot.
Because domestic margins are lower.
Right. Export margins to the U.S. are usually very fat. Domestic margins can be much thinner. So when they say limited impact on operations, that might be true. The factories will keep running. But limited impact on profitability, that is a huge question mark.
It really feels like the era of free trade is officially dead and buried. We are just in a world of managed trade, heavy subsidies, and retaliatory tariffs now.
It's certainly hibernating. The global flux is very real. You just cannot rely on open borders anymore. And actually, speaking of reversing dependencies and using government subsidies, we have to talk about the second big story in our sources today.
The pharma story.
Yes. Because while the U.S. is basically putting up walls against our solar panels, India has just successfully rebuilt a fortress it lost 20 years ago.
You were talking about the penicillin G story from Mint.
I am. And this is, in my opinion at least, the most significant business case study of the entire day. It's an incredible story of redemption.
I read this report and it seriously felt like a history lesson and a corporate thriller just rolled into one. For those who don't know, penicillin G isn't just a drug you go and buy at the pharmacy. You don't walk into a clinic and say, hey, give me some penicillin G.
Right. It isn't a finished dosage form. It is what the industry calls a KSM, a key starting material. Think of it as the raw flour for a bakery. You cannot make a huge range of very common antibiotics, things like amoxicillin, cloxacillin, the basic stuff you give your kids when they get an ear infection. You can't make any of that without penicillin G.
And the crazy thing to me is that India used to make this stuff. Like, we were completely self-sufficient.
We were a major producer back in the 90s. We had 4 or 5 big fermentation plants running. We were even exporting it. But then right around the early 2000s, China entered the market. And they entered with what we call predatory pricing.
Meaning they just dumped the product at rates nobody else could possibly match.
Exactly. A classic brutal price war. They lowered the prices until every single competitor went bust.
And they won.
They won completely. They wiped us out. The last Indian plant shut down almost 20 years ago. And since then, the so-called pharmacy of the world, India, has been 100% dependent on China for the most basic ingredient needed to make antibiotics.
Which is absolutely terrifying when you think about it. I mean, we saw what happened during the 2008 Beijing Olympics when China shut down factories just to clean the air prices spiked globally. And obviously, we all saw what happened during COVID when the supply chains completely froze. If China sneezes, literally, India runs out of medicine.
It was a massive national security risk, plain and simple. If you cannot make your own basic antibiotics, you are incredibly vulnerable to geopolitical shocks. But today the news is that Aurobindo Pharma has officially commissioned a massive new plant to manufacture penicillin G right here in India. And the scale of this thing is staggering.
Yeah, the numbers in the report really stood out to me. It says India consumes about 3,000 tons internally every year, but this new Aurobindo plant has a capacity of 15,000 tons.
And that is the huge aha moment here. They aren't just building this for import substitution, they're building for global dominance. They want to export, they want to take the fight directly back to the global market.
But how? That's what I don't get. If China could undercut us before and drive us out of business, why can't they just do it again? Why won't China just drop their price to practically zero tomorrow and bankrupt Aurobindo?
That is the billion-dollar question. And the answer lies in the PLI scheme, the production-linked incentive. The Indian government is effectively subsidizing every single kilogram that Aurobindo produces. This levels the playing field against the Chinese state subsidies.
So it's basically a subsidy war. It's our government versus their government, but they're fighting it through these private companies.
It is exactly that. But you have to look at the economics to see why it's worth it. The Met report mentions that the price of penicillin G had recently spiked to over $24.58 per kilogram.
Wow.
Right. And that is exactly what happens when you have a monopoly. China could just dictate the price whenever they wanted. By bringing this new 15,000-ton capacity online, India effectively caps that volatility. Even if this Aurobindo plant just breaks even, the value to the Indian healthcare system in terms of price stability is massive.
It's a huge industrial counterpunch. The U.S. hits our solar with tariffs, so we break China's chokehold on pharma. It really goes to show that industrial policy, heavy government intervention is totally back in fashion globally.
Oh, absolutely. The invisible hand of the market has basically been replaced by the visible fist of the government.
The visible fist, I like that.
Yeah.
But, the fist can't fix everything. And I want to pivot now to the broader macroeconomic health check in our sources today. Because despite these very specific wins, the solar investments, the new pharma factories, the macro picture for India in the December quarter, Q3 of FY26, looks a little, sluggish.
Sluggish is a very polite way to put it. We are definitely seeing some real cracks in the broader growth story, despite what the Sensex is doing.
Right. So the overall GDP growth momentum has slowed in Q3. But the specific metric that really scared me in the Economic Times report was CapEx, capital expenditure. It dropped 7.4% in the December quarter compared to the previous quarter.
And CAPEX is the ultimate confidence metric for an economy. It represents companies spending actual money today to build the factories of tomorrow. It's buying new machinery, expanding operations, building new offices. When CapEx drops by 7.4%, it means corporate India is hitting the pause button hard.
But why? I mean, if the Sensex is sitting at 82,000 and everyone is cheering, why are these same companies scared to build factories? Is it that uncertainty level A and B thing again?
That definitely plays a huge part. Delayed spending due to elections often causes a temporary pause as the private sector takes a wait-and-see approach. But I think the rot is actually a bit deeper. I think it's about the cost of money. And this brings us to what is probably the most technical but absolutely the most dangerous metric in our entire source stack today.
The credit deposit ratio.
Yes, the CD ratio.
Okay, can you just explain this to me like I'm 5 years old? Because the report says it's above 80%, and everyone seems worried, but why does that actually matter?
Okay, let's keep it super simple. Imagine a bank is just a giant piggy bank. Regular people put their savings into it. Those are the deposits. Then the bank takes that pool of money and lends it out to businesses and home buyers. That's the credit.
Got it.
If you have 100 rupees in deposits and you lend out 80 rupees, you have a CD ratio of 80%.
Which seems, I don't know, that seems really high. That means for every dollar they take in, 80 cents is already out the door.
It is very high. It means the bank has very little cushion left. If a few big depositors want their money back, or if a few big loans go bad, things get incredibly tight. When the ratio pushes over 80%, banks essentially run out of money to lend.
So what do?
Well, they have to scramble to get more deposits, which usually means they have to raise the interest rates they offer on savings accounts to attract fresh cash. But paying higher interest hurts their own profit margins. So more likely, they just tighten their belts and stop lending as freely.
A credit crunch.
Exactly. Liquidity just dries up. And we are seeing the very real victims of this right now. The NBFCs, the non-banking financial companies, and the fintech startups are absolutely starving for capital right now. They rely on borrowing from the big banks in order to lend to consumers. If the big banks close the tap, the NBFCs dry up instantly.
Which obviously trickles right down to the regular guy on the street. If I need a personal loan or if I'm running a small business and I need working capital, it's suddenly much harder to get approved or the interest rate is just punishingly expensive.
Correct. And we are seeing the very human fallout of this in a specific, honestly, somewhat dark industry that is covered in the reports today. There's a huge boom in debt settlement companies.
Yes. Startups like Freed, I saw this in the notes. Freed, it's a very paradoxical name.
It really is. These companies basically help people who are completely drowning in retail debt people, juggling multiple loans post-COVID. They help them negotiate with the banks to settle and pay back less than what they actually owe. The fact that this specific debt settlement industry is rising so fast tells you everything you need to know.
It's a stark contrast. The top of the K-shaped recovery is buying stocks and watching the Sensex hit all-time highs, while the bottom of the K is literally hiring debt counselors just to survive.
Exactly. And that gap, that massive divergence, is exactly where the long-term political and economic risk lies.
Okay, I want to shift gears completely here. We've spent the first half talking about the old world, physical factories, bank loans, shipping containers, physical tariffs. Now let's talk about the new world. Because there is a manifesto in our source pile today that absolutely blew my mind.
Ah, the orchestrator.
Yes. It's titled The Orchestrator. And honestly, this is deep, deep stuff. It's not just your standard tech news update. It's a conceptual pivot. It's a glimpse into how work is fundamentally going to change over the next 5 years.
Why the AI is the computer. That is the core argument here. And it challenges basically everything we think we know about artificial intelligence right now.
It really does, because right now, the argument is that we are thinking about AI all wrong. We are treating it like a smart chatbot. You type a prompt, it spits out an answer. But this manifesto says that is an incredibly primitive interface. It's moving away from ASI, artificial superintelligence, as this sci-fi concept, and framing it as a highly capable digital worker.
The manifesto makes this brilliant historical comparison. It compares the current chatbot interface to the old MS-DOS command line.
Right, the black screen with the green text.
Exactly. With MS-DOS, you had to type the commands perfectly, or it didn't work. It was tedious. Then came the GI, the graphical user interface.
Yeah.
The mouse, the windows, the folders you could click on. This manifesto argues we are exactly at that transition point right now for AI.
There was a quote that really stuck with me. It said something like, unless you want a full self-driving horse, you have to admit the interface has never mattered as much as the actual computer.
It's a great line. And the whole thesis revolves around this concept of orchestration. See, right now, we treat AI models like these solitary, isolated geniuses. You ask GPT a question, it answers. You ask Claude, it answers. But the manifesto points out a massive limitation. Even the best AI model cannot do its best work alone.
Right. The quote was, Claude only co-works with Claude. GPT only talks to GPT.
Exactly. So the future isn't just one giant monolithic superbrain that knows everything. The future is a team. It's an orchestrator.
So a system that delegates.
Yes, a harness. You use a master system that manages a team of highly specialized digital workers. You might have one AI model that is hyper-optimized just for writing Python code. You have another one that is built entirely for logical reasoning. Another one just for creative writing.
So the definition of the computer changes. The computer is no longer just the hardware on your desk or the UI you click on. The AI actually is the computer.
Exactly. It has its own file systems. It has true internet access. The manifesto talks about how this finally solves the quote-unquote read problem of the web.
What does that mean exactly? Solving the read problem.
Think about what Google did. Google solved the search problem. It can scour the internet and find a specific page for you. But Google can't actually read the page, understand the deep context, compare it to 10 other pages, and then synthesize a nuanced answer. Humans still have to do the actual reading. This manifesto says AI orchestrators are finally solving the read function. They can browse the web and comprehend it like a human would, but at machine speed.
Okay, so practically speaking, if the AI really is the computer, if I can just open my laptop and tell my orchestrator, hey, build me a fully functional e-commerce website for selling shoes, and the orchestrator goes out and hires a digital coder agent, a digital designer agent, and a digital copywriter agent, and they just do it autonomously. what happens to the humans?
Yeah.
Specifically, what happens to the massive human workforce in the Indian IT services sector?
That is the multi-billion-dollar reality check right there. And today's sources actually give us a fascinating split screen on this exact issue. We have statements from two titans of Indian IT, TCS and LTIMindtree, and they are giving completely different vibes on this.
Right. We have K. Krithivasan from TCS on one side and Krishnan Iyer from LTIMindtree on the other.
Let's start with Krithivasan from TCS. He is taking what you might call the abundance mindset. He is on record saying TCS is basically, quote, fine with AI. He argues that even if AI cannibalizes some of their traditional revenue like basic, repetitive coding tasks, it is going to create entirely new kinds of work that we can't even imagine yet. He's betting that the global demand for software and tech services is essentially infinite.
Which is the classic optimistic Silicon Valley take, right? Technology never actually destroys jobs, it just changes the nature of the jobs.
Right. But then you look at Krishnan Iyer from LTIMindtree. He is significantly more cautious. And he brings us right back to that uncertainty level concept we talked about in the intro. He points out a very practical, critical flaw in the whole AI is computer theory, which is risk and accountability.
He says, sure, the AI can write the code quickly, but who is actually checking to make sure that code doesn't accidentally break the bank?
Exactly. In mission-critical operations, we're talking about banking systems, healthcare records, aerospace. You simply cannot afford an AI hallucination. You need strict human accountability. Iyer is essentially saying that the role of the human in IT shifts from being a creator of code to an auditor of code. And that transition is going to be incredibly messy.
He's the one experiencing the uncertainty level A in the morning and level B in the afternoon. It is really hard to sell the dream of full AI autonomy to a legacy bank client that is absolutely terrified of a data security breach.
It really feels like the orchestrator manifesto is the afternoon forecast. It's the bright, shiny, theoretical leap where AI does everything seamlessly. But the Indian IT executives are stuck dealing with the morning forecast. The messy, practical reality of service contracts, legal liabilities, and bugs.
It's the friction of 2026. We theoretically have the tech for autonomy, but we are completely trapped in the regulatory and risk frameworks of 20 years ago.
Exactly.
Okay, speaking of physical frameworks and limitations, let's move to segment 5. Because while digital workers are amazing to think about, we still live in a physical world. We need to move actual goods, and we need to generate physical energy.
The real nuts and bolts of the economy. You can't ask an AI agent to drive a shipping vessel just yet.
Exactly. We mentioned the $350 billion target for the renewable energy sector earlier. That is a massive amount of capital flowing into infrastructure. But the auto sector is the one that really caught my eye in the reports today because they are facing what looks like a regulatory gun to the head.
You're talking about CAFE 3.
CAFE 3, yes. It stands for Corporate Average Fuel Economy, and the new norms officially kick in by April 2027.
Which is basically tomorrow in the automotive world. Developing and launching a new car platform takes years. April 2027 is a blink of an eye.
So what do these rules actually enforce? Why is the industry freaking out about a deadline that's 12 months away?
They are incredibly strict. They force the automakers to significantly lower the average carbon emissions of their entire fleet, every single car they sell. If you are a company that sells too many heavy gas-guzzling SUVs and you don't sell enough EVs, your corporate average shoots up, and you get hit with massive, punitive financial penalties from the government.
So if I am Maruti Suzuki or Mahindra, I have to aggressively flood the market with EVs or hybrids over the next 12 months, basically forcing a hard transition, regardless of whether the consumer demand is naturally there yet.
You absolutely have to. Your other option is to buy carbon credits from a competitor like Tata Motors, for example, who already sells a large volume of EVs. It's essentially a massive forced transfer of wealth from legacy combustion engine makers to green tech pioneers. Expect to see an absolute flurry of EV launches this year. It is forced evolution by regulation.
Wow. And then, staying on the topic of massive physical infrastructure, there is this shipping story. This one definitely flew under the radar for a lot of mainstream outlets, but I think it's highly strategic. The big oil, PSUs, Indian Oil, BPCL, HPCL, they're taking a 35% stake in a joint venture with the Shipping Corporation of India.
SCI, yeah.
Why do oil companies suddenly want to be in the boat ownership business?
Because of what we call the invisible drain. Right now, India imports massive amounts of crude oil. We pay global market rates for the oil itself, obviously, but we also pay foreign shipping companies to actually transport that oil to our ports. And that annual freight bill is astronomical. It's roughly 6 lakh crore rupees every single year.
Wait, 6 lakh crore just for the shipping transport?
Just for the transport. That is an unbelievable amount of money just bleeding out of the Indian economy and going directly into the pockets of foreign logistics giants. By acquiring a massive stake in these shipping vessels, these public sector oil companies are trying to keep that value domestic. They will essentially be paying themselves to move their own oil.
That perfectly ties back to the penicillin story we started with, doesn't it? It's all about strategic autonomy.
100%. Secure the basic drug supply chain, secure the energy transport logistics, build the fortress. It is the single most consistent theme across every single sector we've looked at today. Whether we are talking about data, drugs, or diesel, the ultimate goal right now is ownership and control.
Okay, we have covered some incredibly heavy systemic shifts. Let's pick up the pace a bit. It's time for the market and corporate lightning round. Just quick hits, high-impact stories from the sources.
Let's go.
First up, the ride-hailing wars are back. I honestly thought Uber had already won this war years ago, but they're gearing up again. Uber is pumping 3,000 crore rupees into India specifically to battle Rapido.
Rapido was the classic underdog that bit back. They basically cornered the two-wheeler and auto rickshaw market, while Uber was solely focused on premium four-wheeler cabs. Now Uber realizes they left a massive market share on the table, and they're trying to claw it back. For you, the consumer, this is fantastic news. Expect heavy discounts, cheaper rides, and better driver availability as these two giants just burn cash to fight each other.
Next up, telecom trouble. The headline is, quote, "Call drops for China." This sounds like a wild conspiracy theory, but it's literally in the financial papers today.
It is. Users of major Chinese smartphone brands, specifically Xiaomi, Oppo, and Vivo, are suddenly reporting massive connectivity issues across India. Severe call drops, totally unexplained data failures. It's leading to this new trend they're calling the Great Disconnect, where users are aggressively switching away from these brands.
Is this just technical incompetence from the phone makers, or is it something else?
We don't have hard proof either way. But the timing is incredibly suspicious given the broader geopolitical tension. And here's the really interesting twist from the government side. The government is signaling that they might actually not extend the strict SIM binding norms.
Why does that matter?
Well, usually, national security hawks want strict SIM binding to prevent fraud. By potentially relaxing it, it suggests the government might be prioritizing consumer convenience right now, specifically to make it as easy as possible for citizens to switch their phone brands quickly.
Oh, wow. Just letting the market naturally solve the hardware problem.
Exactly.
Fascinating. Okay, next. Finance moves. IFL Finance is raising $750 million via bonds and external commercial borrowings, and Vedanta is clearing a 3,000 crore fundraising round. Also, the RBI has summoned Yes Bank executives over a Forex card data breach.
The big takeaway on the fundraising is that for the really big corporate players, the credit crunch we discussed earlier simply doesn't exist. The global bond markets are wide open to them. They can raise massive amounts of cash via ECBs. The credit crunch is strictly a problem for NBFCs, small businesses, and individuals. It's just another glaring example of that K-shaped reality.
And finally, for the lightning round, we have a signal for the crypto crowd. Google search trends for the phrase, quote, "Bitcoin dead" have spiked massively.
I genuinely love this metric. In financial markets, broad public sentiment is very often a contraindicator. When retail investors are all searching "Is Bitcoin dead?", it historically marks the absolute bottom of the market cycle. Extreme public fear almost always precedes a major buying opportunity.
So buy when the blood is in the streets, or in this case, when the Google searches are in the gutter?
Something like that. If you have a high risk tolerance, that search spike is actually a very bullish signal.
All right, let's zoom out one last time before we wrap up the show. Geopolitics and borders. The physical borders of the world are changing rapidly.
The world is definitely becoming much less frictionless. Look at the UK visa story. They have officially enforced a fully digital travel system. They are requiring mandatory visas for Indian travelers and an electronic travel authorization, or ETA, for others.
So the days of just showing up with their passport and getting a physical stamp at Heathrow are over.
Completely over. You need mandatory pre-clearance now. The physical border has effectively moved from the airport arrival hall in London to the smartphone app in your living room before you even pack your bags. It's highly efficient, sure, but it's also a massive control mechanism. It allows the host country to screen you out digitally before you ever step foot on a plane.
And looking closer to home, the Prime Minister sent a very direct message to Israel today. He emphasized, quote, India with Israel in this moment addressing the Knesset.
It was a very strong public statement of solidarity. It really reinforces the strategic axis between the two nations. You have to remember, Israel is a vital supplier of advanced defense tech and agricultural water tech to India. This isn't just about diplomatic sentiment. It's deeply tied to business and security.
And finally, Finance Minister Sitharaman clarified the rules on foreign cross-border inflows. She said the scrutiny on beneficial ownership applies broadly, and she specifically added, quote, not specifically talking about China.
Right, well, that is classic diplomat speak. Everyone in the market knows it's entirely about China. It just confirms that the invisible wall is still very high. Any investment capital coming from a land-bordering neighbor is going to be vetted with an absolute microscope. This perfectly explains why foreign direct investment numbers have been so tepid recently. The government gatekeepers are working overtime to scrutinize every dollar.
So let's look at the entire board we've laid out today. We have U.S. solar tariffs hitting 126%. We have India massively subsidizing pharma factories to block Chinese dominance. We have AI orchestrators threatening to replace the traditional computer OS. We have a severe credit crunch squeezing the middle class while the corporate giants raise billions overseas. It is an incredibly dense, complex day.
It is. But if you take a step back and look closely, there is actually a very coherent story running through all of this. It's a dual story of fortification and transformation. We are aggressively fortifying our physical supply chains while simultaneously trying to transform our digital ones.
Fortification and transformation. I really like that framing. So let's wrap this up with our investor's cheat sheet, the outro. We need to give you the top 10 keepers. The 10 absolute most relevant long-term developments from today's sources that you need to tattoo on your brain.
Okay, let's run them down.
Number 1.
The solar tariff wall. That 126% U.S. duty on Indian solar fundamentally changes the export calculus. If you hold renewable stocks, you need to check their U.S. revenue exposure immediately. Look for the companies that are successfully pivoting to domestic demand or non-U.S. markets.
Number 2.
PLI validation. Aurobindo's massive new penicillin G plant proves that India actually can reverse engineer supply chain independence from China. This is a huge green light for investors to start looking seriously at other PLI-heavy sectors, like electronics manufacturing and specialty chemicals. The government support is real and it works.
Number 3.
The orchestrator era. You need to stop looking at basic single-model chatbots. Start looking at agentic AI and multi-model systems that manage entire digital workflows. The companies that successfully build the harness or the OS for these digital workers will be the next trillion-dollar tech giants.
Number 4.
CAFE norms. This is the regulatory gun to the head for the Indian auto sector, and the deadline is April 2027. Expect wild volatility in auto stocks as they scramble to electrify their fleets. The legacy leaders who are slow to adapt will suffer, while current EV leaders will have a massive financial advantage through selling carbon credits.
Number 5.
Strategic shipping. Oil PSUs aggressively entering the shipping business is a massive deal. It's a long-term structural change designed to cut that 6 lakh crore foreign freight bill and keep capital within India. It's a surprisingly bullish signal for the state-owned energy sector's long-term efficiency.
Number 6.
The credit squeeze. A CD ratio above 80% signals severe banking liquidity tightness. You need to watch out for stress or forced consolidation in the NBFC sector. Avoid banking stocks that have poor deposit-gathering franchises. Cash is king in a tight market.
Number 7.
Ride-hailing capital wars. Uber's 3,000 crore injection proves the Indian mobility market is far from settled. This war will burn massive amounts of corporate capital, but it will ultimately expand the total addressable market size for whoever survives.
Number 8.
Digital protectionism. From the UK enforcing mandatory e-visas to the US slapping triple-digit tariffs, the global flow of both people and goods is getting significantly more expensive and heavily monitored. The frictionless, globalized world is retreating.
Number 9.
Energy ambition. The $350 billion renewable investment target by 2030 provides a massive, multi-decade infrastructure play that will happen regardless of what the U.S. does with export tariffs.
And finally, number 10.
Crypto cyclicality. The sudden spike in Bitcoin dead sentiment searches serves as a classic contrarian entry signal. It's a reminder that extreme negative public sentiment often marks the bottom of the cycle for digital assets.
So what is the final word here? How do we actually survive the schizophrenia of this market?
Honestly, you just have to accept the dissonance. The morning news is always going to be full of that uncertainty level A, the chaotic friction of the old globalized world breaking apart. But the afternoon brings the orchestrator, the massive technological promise of the new world being built.
So the job of the investor is essentially to survive the morning friction so you can enjoy the afternoon abundance.
That's the game. That is exactly the game.
Well, that is it for today's deep dive into the sources. We will be back tomorrow to see if the uncertainty level has upgraded to a level C or miraculously downgraded to 0.
I really wouldn't bet on 0 anytime soon.
Yeah, neither would I. See you then. Goodbye. And just one final provocative thought to leave you with today. If the AI is truly becoming the computer, and that computer can now work completely autonomously while you sleep, are you still the boss of your business, or are you just the person paying the electricity bill? Think about that.